The U.S. stock market is currently closed for the weekend on this Saturday, June 6, 2026. The final regular trading session concluded yesterday on Friday, June 5, 2026 at 4 p.m. Eastern Time, with NUBURU Inc. trading under the ticker symbol BURUR on the NYSE American exchange, wrapping up the session at an exact closing price of $0.16 per share, representing an intraday decline of 5.88% from its opening levels. While standard market narratives might cause casual onlookers to interpret this penny stock status as a sign of terminal distress, the reality underlying this microcap stock reveals an entirely unexpected strategic pivot into the high-stakes European defense, cybersecurity, and counter-drone sectors. Most everyday market participants look at sub-dollar stocks and assume they are looking at structural decay, but institutional trackers are noticing a massive corporate restructuring that completely reframes the risk profile of this industrial asset. When retail investors think about high-growth technology plays or search for investment help across online investing networks, their focus instinctively shifts to high-visibility options like Tesla stock, Apple stock, or Nvidia stock, assuming that smaller companies have nothing left to offer but liquidation risks. The mainstream consensus surrounding NUBURU is heavily defined by its historical capital struggles, including a persistent battle with NYSE American listing compliance due to severely depressed stockholders' equity. However, the contrarian reality is that management has just executed an aggressive series of cross-border partnerships and defense tech acquisitions that could fundamentally reset its financial trajectory. By shifting its core narrative from a niche commercial hardware manufacturer to a dual-use military and infrastructure software framework, the company is forcing the street to reassess where expectation ends and actual asset value begins. Looking closely at recent stock movement reveals an intense tug-of-war between extreme short-term liquidity pressures and massive institutional speculation. Trading volumes have exploded far beyond normal baseline averages, with over 34 million shares changing hands in yesterday's session alone, contrasting with a massive 66 million share surge earlier in the week. This intense churn points to high retail activity on popular trading apps like the Robinhood app, or through low-cost online investment portals, where fractional shares and microcap trading dominate. Yet this is not just random meme stock behavior, it is a direct market reaction to massive structural announcements that dropped over the last few days. Just hours ago, the company announced a binding alliance with Italian firm SunCubes to establish a dedicated laser arm within its defense and security framework, a move directly targeting the rapidly growing directed energy and counter-unmanned aerial systems markets across allied Western regions. This follows an earlier announcement this week regarding their subsidiary Orbit, which pulled in substantial cumulative orders from a Tier 1 national telecommunications infrastructure operator for its new cybersecurity framework and Microsoft Azure cloud migration support. When individuals managing their own assets through self-investing accounts or evaluating choices on major investing sites see these operational milestones, it creates a massive divergence between the depressed share price and the expanding operational pipeline. Understanding this tension requires examining the company's financial turnaround strategy outlined in their first quarter reports for 2026. For a long time, the central bearish thesis against this stock was its negative equity position, which triggered formal non-compliance notices under Sections 1003 AI1 and 1003 AI2 of the NYSE American Rulebook due to historical net losses and an equity deficit that hit roughly $15.2 million at the end of last year. But the actual first quarter performance numbers completely disrupted that negative outlook. The company reported its first material revenue generation of $407,644, trimmed its net quarterly loss to just $459,898, and pulled off an incredible $17.35 million improvement in stockholders' equity, bringing the total back into positive territory at $2.17 million. Management explicitly stated that they expect to hit the even higher $4 million equity requirement by the second quarter, which would allow them to completely shed the non-compliance indicator that has dragged down investor sentiment on platforms like the Interactive Brokers platform or the Fidelity trading platform for quarters. To fully understand how this asset operates, one must look at the underlying core technology and business model that built the enterprise before this defense pivot. Founded in 2015 and headquartered in Denver, Colorado, the company established itself as a pioneer in the development and manufacturing of high-power, high-brightness blue lasers, specifically marketing units like the NUBURU AO150 and the NUBURU BL. Historically, industrial manufacturing relied almost exclusively on infrared lasers, which suffer from poor absorption rates when working with highly reflective metals like copper, aluminum, and gold. The company's blue laser technology absorbs these specific metals up to 20 times faster than traditional infrared systems, allowing for dramatically faster, defect-free welds and advanced 3D printing capabilities across electric vehicle battery manufacturing, consumer electronics, and aerospace production. This technological edge was undeniable, but commercial adoption was slow, capital-intensive, and left the company burning through cash reserves, leading to a severely damaged balance sheet. This clear gap between historical cash burn and engineering potential is exactly why the recent transition toward defense infrastructure is a critical point for anyone conducting an in-depth stock analysis.
In late May, the company signed a binding agreement to acquire a 70% majority stake in Tecne, an Italian defense firm, valuing the entity at 52 million euros pre-money. This deal, which has initiated the formal golden power filing process with the Italian government to clear national security regulations, positions the combined entity to tap into an estimated $459 million of projected revenue between now and 2030. By merging their high-power blue laser IP with automated software command layers and established volatile contracts, they are effectively transitioning away from a pure hardware vendor model and stepping into the sovereign defense ecosystem. For everyday individuals using retail platforms like SoFi Invest or tracking microcap volatility on Interactive Brokers trading accounts, navigating a stock like this requires separating raw market emotion from hard mathematical realities. Please take a moment to engage with the channel and state your current position. Comment below how many shares of NUBURU you currently hold, or share your outlook on whether you believe their defense pivot will successfully save them from their listing compliance struggles. This type of community data points to the exact retail interest driving the massive daily trading volumes we are seeing. When you look at the macro picture, a microcap stock trading around 16 cents carries inherent structural risks, including potential share dilution through future capital raises and extreme volatility triggered by algorithmic trading filters. But it also represents a classic asymmetric setup where the market's expectation of absolute failure is being systematically challenged by real-world operational changes. The older financial reports showing deep revenue deficits are lagging indicators, whereas the new European defense alliances and the restoration of positive stockholders' equity are leading variables that the broader market has not fully priced into the equity. As we look toward the future, the central focus for the stock will be the successful execution of these international acquisitions and the formal removal of the NYSE American non-compliance tag. If the company successfully hits its $4 million equity target in the upcoming second quarter filings and closes the total acquisition of the Orbit software platform by the end of the calendar year, the fundamental structure of the company will be completely different from the business that entered 2026. Retail investors utilizing Fidelity investments or setting up automated balances through automated tools like Schwab Intelligent Portfolios often overlook these tiny corporate transformations because they carry high beta and require massive risk tolerance. However, for active trading accounts on the Robinhood app or those utilizing specialized individual brokerage tools, the ongoing volatility presents a highly technical battlefield where short-term price discovery is driven entirely by headline execution. Ultimately, the story of this stock is a clear example of the constant battle between market expectation and fundamental reality. The expectation is that a sub-dollar industrial manufacturer is stuck in a cycle of compliance issues and low commercial traction. The reality is an aggressive cross-border corporate reorganization designed to transform the business into a specialized defense and cybersecurity player with positive equity and significant projected revenue access. Whether management can flawlessly navigate the Italian government's regulatory approvals and convert these massive commercial visibility pipelines into recognized top-line growth remains the multi-million-dollar question. For now, the stock sits at a critical technical baseline, offering an incredibly stark contrast between its depressed historical chart and its highly ambitious operational future.